In this presentation, we will record transactions related to an enterprise fund, recalling that there are three categories of funds. We have the governmental funds, we've got the proprietary funds, and we have the fiduciary funds. Governmental funds being the largest grouping of funds, the funds within them being on a modified accrual basis. Proprietary funds then being on an accrual basis, the enterprise fund being part of the proprietary funds. We've got the enterprise fund and the internal service fund being the two typical proprietary funds, them acting similar to for-profit organizations typically having customers. The difference between the two, enterprise fund and the internal service fund, the two proprietary funds, is that the enterprise funds has customers outside of the entity, outside of the government, whereas the proprietary fund or the internal service fund, we're talking about a proprietary fund where the customers are all internal to the organization, internal to the government. So we will go through these transactions with the enterprise fund, a proprietary fund, relatively quickly. We're going to group the transactions together because it will be similar to, or it will be using an accrual basis and therefore similar to what most of us would be familiar with. Then we'll go through the closing process and take a look at some examples of financial statements with them. So first we have the rental income. So we're going to record rental income and cash received. Rental income and cash received. First recording the rental income, we're going to say that it's going to be a normal accrual type of transaction. Rental income being the income account, the other side going to the accounts receivable, as we would basically expect if we were to basically invoice for the rental income on an accrual basis. So rental income statement type of account going up. Of course, we have our trial balance on the right-hand side, it being green accounts being assets, orange accounts being the liabilities, the light blue being what would be equivalent to the equity section in a for-profit organization. Net position here, everything below that dark blue being what would be similar to the income statement account, the temporary accounts, those accounts that would close out to what would be the equity like retained earnings or the capital account. Here, net position. So we have rental income going up, that being an income statement account, a revenue type of account. The other side being accounts receivable going up in the debit direction to the 94,464. Then we're going to have the cash that's received on it. So we're kind of jumping forward in time and we're saying now there's cash received. Normal type of transaction received on the receivable would be that the cash would be increasing on an accrual basis with a debit. Other side being accounts receivable going down. If we record that out, then cash goes up with the debit, and we've got the receivable then going down with the credit. Next transaction, we've got cash expenses. We've got the admin expense, maintenance and repairs, supplies and materials, utilities. All these expenses we will record at this time. We're going to say that that is going to be a debit to those expenses, of course, just like it would be with normal kind of accrual accounting, and we're paying cash for it, not because we're on a cash basis method here. It's just this transaction happens to be one which we're saying we paid cash for it at the same time that we basically had or incurred these expenses. So if we record this out, then we're going to say, all right, here's the 25,210 in the admin expense going up, the maintenance and repairs going up in the debit direction. We have the supplies and materials going up in the debit direction, and the utilities going up in the debit direction. The credit side then going to cash. So cash then being credited, that takes us to a negative number. Don't let that throw you off. Cash is overdrawn. We will have revenue shortly, or cash increasing. And then we have a transfer from the general fund. So we're going to say that there's a transfer now. This is something that will, of course, be different in the governmental accounting than most for-profit accounting, because the general fund is going to be another fund within the entity, within the organization. It's going to be leaving the general fund, this cash, and going into the enterprise fund. So we are in the enterprise fund, so we're going to say that the cash is increasing with a debit. So cash goes up with a debit. The other side is going to go to the interfund transfer in. Interfund transfer in, acting similar to a revenue type of account in like the temporary account category down here. However, it's not exactly the same, but it's going to be acting in the same fashion within those temporary accounts, affecting what is kind of like net income, bottom line of the income statement, similar type of number in a similar way, increasing it. So the cash then going up, we've got cash had a credit before, it was overdrawn, we debited it by 61,000. It's now at a positive 15,202, which is nice. And then we've got the interfund transfer end. It's going to be down here on the income statement, going from 0 up in the credit direction. Again, acting like basically a revenue account, doing the same kind of thing that the revenue account did as we saw on the rental income. Revenue minus expenses being basically the change in that temporary type of account, similar to what net income would be. Then we're going to record depreciation. We are on an accrual basis, therefore the depreciation in the enterprise fund is what we would expect, as opposed to governmental type funds, the main category of funds being on a modified accrual basis and therefore not having long-term assets, capital assets, property, plant, and equipment on the books there, therefore not having depreciation or accumulated depreciation. Either enterprise fund is on an accrual basis, therefore does have depreciation, capital assets, and the related depreciation and allowance for them. So we're going to debit the depreciation expense for the $3,520, credit the allowance for depreciation. If we record that, then we're going to say the depreciation is going to be down here. It's going to be increasing in the debit direction. We have accumulated or allowance for depreciation increasing in the credit direction, which of course brings down the book value. Now you'll note here that we have land, building, and the accumulated depreciation is greater than what the building would be. And normally we would say that land is not depreciated, the building would be, and so you would think that this number would be less than the 1 million. So don't let that throw you off. In the example problem here, we're basically netting the land and building would be the amount of assets we're saying is depreciable in this case. Then the allowance is going to be like accumulated depreciation at the 1,243,000. Again, of course, the allowance typically being less than the property, plant, and equipment that it is related to. Then we're going to go to the next transaction of closing entries. Everything below basically what would be similar to the equity section, in this case the net position, the light blue area, is what we're going to close. So if we go down below, we're going to say we have the rental income. It's got a credit of $94,464. We then are going to debit it for the $94,464 to make it go down. We've got the interfund transfer in, acting like basically an income type of account. We're going to debit it to make it go down. And then we have all the expenses, the $25,210 down to the $3,520. Those being debits, we then, of course, crediting them to make them go down. And then the difference is going to go to the net position unrestricted, which is similar to basically the equity account, or similar to the equity account, similar to retained earnings for a corporation, or to the capital account for a sole proprietor. So if we record this out, then we're going to say that the rental income started at the $94,464. It's going to go down with a debit to 0. $61,000 to the transfer in credit. We're going to debit it to make it go down to 0. And then all of these expense accounts, of course, having a debit balance, we do the opposite, crediting them, making them go down to 0. The difference going to the net position at $60,036 to begin with. We increased it because in essence we have an increase, kind of like net income as opposed to a loss, increasing the net position to $75,953. This then being our post-closing trial balance on this side. Assets minus liabilities. We don't have any liabilities, therefore the assets are equaling what would be similar to the equity or net position. Now we're going to go through the financial statements, looking at the statement of revenues, expenses, and changes in fund net position, in essence, the income statement like account. We're going to be taking a look at those accounts below what would be like the equity section, the net position section, the temporary type of accounts here. So we're going to start off with the operating revenues. That's going to be the rental income. So rental income has a credit here. It's going to be the only item we're going to put in revenue in the operating revenues. So if we're going to put it in the outer column. We're not going to be including the interfund transfer here because that's not really revenue. That's a transfer from the general fund. It's not part of the normal operations because we're thinking about the enterprise fund as basically its own entity earning revenue and having its own expenses. So therefore, we're going to put the transfer in, although it's increasing kind of like the net income type of number, the temporary number, the net temporary number. We're going to put it some place else in our statement. Then we have the operating expenses, which is going to be the admin, maintenance, supplies, utilities, depreciation. Admin, maintenance, supplies, utilities, depreciation. We pulled them into the inter column because we're going to have a subcategory. So we pulled them into the inter column. We're going to put a little line, underline underneath them, of course, and then subtotal them into the outer column. That giving us the total operating expenses of $139,500. 547. Then we'll subtract these out. We got the 94,464 minus the 139,547. That gives us the 45,83. That's going to be the operating loss. Now, of course, we have a loss here because with the rental income is less than the operating expenses. Now, you might say, well, we had a gain down here. We said it was a gain before. Why? Because we haven't included the transfer in from the general fund yet. So right now we're at a loss, and then we're going to say that we had a transfer in of 61,000. That's from the general fund. So that's fund to fund transfer, where in the enterprise fund came from the general fund. Then the 4583 plus the 61,000 brings us back to the positive, back to a change in net position that is 15,917. This is basically the net income number. This is kind of like the net income from operating loss. And this is basically kind of like the net income or the change in the temporary accounts. Then we're going to tie that back into basically what would be similar to the equity section by saying, hey, let's look at the beginning equity. That's going to be the 60,036. So we got the 60,036. That's similar to retained earnings. That's similar to the capital account that we would then close out the temporary activity, the temporary accounts, that what would be similar to the income statement accounts to. So we're going to take that 15,917. Then we're going to add the 60,036, and that will give us to the ending number, the 75,953. That's what we saw on the post-closing trial balance. So here's the post-closing trial balance back to the post, just so you can see that 75,953 there, which matches our 75,953 on the statement of revenues, expenses, and changes in fund net position.